You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of IncResearch.ca, Canada's first online financial news and research service. Welcome to the show, Ted.
Well, it's great to be back, Jim.
I just saw a report that says Canadians are hoarding cash like never before, something like $75 billion extra dollars, because they're scared to anticipate or participate in markets or invest even.
Well, one can hardly blame them, particularly given the way we started off 2016. You know, and it has a lot of people scratching their heads. Why are the markets going through such a volatile period? And there's three factors that are often cited as to what's driving this. And, you know, probably because it's a potential rival to Wall Street, but China seems to, at least on American media, get the number one mention as to the current problems in the market. But, you know, based off of how we see insiders in North America behaving, we just don't buy that. And I'll tell you why. China devalued its currency last summer, and the markets went through a bit of a tailspin. And we saw a lot of insider buying at the time. Insiders stepped in and said, no, this is overdone. Now, we've seen it again. There's been more devaluation pressure on the renminbi, the Chinese currency, in the last few weeks. But this time, American and Canadian insiders have not been stepping up to buy. And, you know, Jim, if it were all about China, then we would see these small cap insiders in the United States, because these companies are primarily geared towards the U.S. economy, not the global economy. We would see them buying. They would be saying, well, this is a bargain. Everyone's selling, and it's all about China, and China doesn't impact our business, so we're going to buy. But no, U.S. small cap insiders are not buying, even though small cap stocks in the U.S. are in a terrible bear market. And so we just do not buy this argument that you hear primarily out of the United States, that it's all about China. China, in our view, is a symptom of the problem. It is not the major cause of the problem. That's not to say you can dismiss what's going on in China, and particularly here for the local economy. I think it is important in terms of what's going on. But in terms of why we have a global bear market, in terms of why U.S. stocks are falling, it's more than China. It's not just about China.
China's the symptom, not the problem.
What we see is that there has been a correlation with global stocks and the oil price. Now, this is a bit odd because there are winners and losers in a low oil price. Canada is usually one of the losers, and we've definitely been a loser, you know, on the grand scheme of things. I know Alberta, Saskatchewan have taken it hardest on the chin. But as a country, our terms of trade have fallen, which means that we cannot buy as many imports as we used to for the same price. So as a nation, we have taken a hit, but other countries should be benefiting. And when you look at what's happening, though, this is not what's unfolding. For example, when you look at the Dow transports in the United States, these are the companies that should be benefiting from low energy prices primarily. Yes, I know there's some railroads in the U.S. that haul coal and oil, but on balance, transport should be soaring with low oil prices, but they're not. So why is there such a correlation between the oil price and, it seems, all global stocks? Well, what it comes down to, Jim, is the financial risk surrounding the debts of these oil and gas companies. Lots of American and Canadian oil and gas companies took on a lot of debt to do a lot of fracking, a lot of drilling, a lot of expensive drilling. You know, these horizontal wells can cost anywhere from $1.5 to $10 million a well. There was a lot of investment in that area since 2009. So one has to ask, well, why is that a bad thing? Well, if you have too much investment in any one area, it is a bad thing. You have overinvestment and overcapacity. Well, why would there be overinvestment in the oil patch? Well, that comes back to this huge distortion we've had in North America and globally by central banks in keeping interest rates too low for too long, for printing money through quantitative easing, and doing all sorts of other little tricks that they can think of to basically artificially inflate markets. But now the chickens are coming home to roost because too much money has gone into some of these areas. We saw it flow into U.S. housing before the last crisis when interest rates were left too low, but somehow the Fed did not learn from that. I mean, they're only academics, and academics, they expect their students to learn, but I guess after you get tenure, you're allowed to turn off your brain or something because, the Fed has been completely culpable here in terms of what's been going on in the energy patch, and the same with the Bank of Canada. The new Bank of Canada governor, Stephen Poloz, took over in late spring 2013. One of the first things he did was start to talk down the Canadian dollar. Fine, that's great. You would say, the tourism industry loves it, the film industry loves it, the lumber industry loves it. This is all very true. But what it did do, unfortunately, it didn't stimulate exports like Stephen Poloz said it was going to. What it did, it created the conditions for more money to flow into the oil patch as monetary policy was loosened when oil was $100 a barrel, Jim. We're not talking last year. We're talking back when oil was trading $100. We had Stephen Poloz driving down the Canadian dollar, not letting market forces determine the Canadian dollar, but he thought that he knew best, that he could quote unquote rebalance the economy into manufacturing. Well, it didn't happen. It got unbalanced into energy. There was a huge final surge of investment into the Canadian oil patch, and now it's ended in tears with a massive recession in Alberta, overbuilding in Alberta. People have lost their jobs. People moved to Alberta in 2013 and early 2014 because capital was raised in the oil patch, and it's been a disaster. And, the Bank of Canada has to take a lot of the blame for that, but of course, it gets off scot-free. It just ceases to amaze me how the Bank of Canada is given a get-out-of-jail card in terms of its policy errors in Canada. It is not being held to account for its blunder in 2013, and it should be, because a lot of people got hurt by its policy decision, and a lot of people are going to get hurt by this continued low interest rate policy that the Bank of Canada continues to inflict on the Canadian economy. Now, it's not all entirely the Bank of Canada's fault. I'm singling them out because as a Canadian, they're the only ones I can try and hold to account. The Fed doesn't really care what any Canadian thinks or what any somebody in the European Union thinks. They care what their constituents think in the United States. All I can really do is raise my concerns about what's going on at the Bank of Canada. And there is a lot to be concerned about going forward, and because there's been a lot that's gone wrong already under the current central bank governor. So we've had this period of artificially low rates. It is still in place, and this is driving now a lot of the volatility in the markets. And we have a big meeting coming up this week, Federal Reserve, where they've got to decide whether they're going to raise rates again. Well, no one expects them to, but what everyone will be listening for is, are they still intent on raising rates 4 times this year? Well, we've seen what's happened the first time, and this is, I would argue, is the driving factor right now behind markets. Is you've got a central bank in the United States that's trying to get off of its easy money policy. Unfortunately, it's a few years too late. So now they're kind of stuck. They're trying to get out of zero interest rates, but it's pretty obvious they cannot. The U.S. economy slipped in the fourth quarter. Projections are that it grew about 0.7%, and we'll know on Friday what that is, whether that is the case. But that's down. That would be down from 2% in the third quarter. So we have a Federal Reserve that's raising rates as the U.S. economy is weakening. Now, I don't think you need to have a PhD in economics to understand that maybe that timing's not so great on that. And so the fact that the markets are having this volatility fit is not a big surprise, and it's going to continue to have this volatility fit until this is resolved in terms of what central bankers are going to do with respect to the predicament they've got in and how they're going to manage it. And right now they're not doing a very good job, either in Canada or in the United States, and I'm afraid there is more volatility to come.
the Shanghai market down another 6%. China says it's going to have limited controls on the market. But again, the Chinese government being, I think, pretty unfamiliar with a free market system, considering how many years of communist rule they've had, their idea of a free market has never been free anyway, has it?
Well, it's all a matter of degree. And sure, they're a little bit more clumsy in how they intervene in the markets, but we have not had a free market in Canada or United States at least since the financial crisis. With this Federal Reserve interfering with the money markets, we have had our own interventions, and this goes completely unmentioned whenever there's criticism of China. It's always, oh, China, they don't know what they're doing. Oh, China, they're interfering with the markets. Yes, this is all true. But what about here at home? Let's talk about our own problems. Let the Chinese worry about their problems. They've got enough problems on their own, but you know what? We have a few here. And the more we point our fingers across the ocean and say it's all China, and look how bad China is, and look how bad they've messed up their markets, we have our own situation here that's a total mess. And when you have the Central Bank of Canada saying that they could bring interest rates down to as low as 0.75%, we have a problem. I mean, this is not the role of the Bank of Canada to juice the economy and manipulate money markets. It says right in the Bank of Canada Act, right in the preamble, it is the job of the central bank to protect the currency, not to drive it down to 60 cents, not to drive it down to 70 cents or wherever Stephen Poles thinks it's going to help his preferred sectors. Their job is to provide stability and to protect the currency, and they're failing. And so we have our own problems. So I get quite frustrated with all the attention that China is being offered. The Chinese stock market is such a small part of its own economy compared to, say, for example, the size of the U.S. stock market to the U.S. economy. It's really an inside baseball game in China in terms of what's going on. Yes, it's a bad indicator in terms of the overall economy, but let's focus on our own situation and let's hold our own policymakers to account. And I think finally, when now people have gone shopping and getting the sticker shock of what tomatoes are costing, what oranges are costing, they're seeing that Stephen Poles is doing a lot of damage to the Canadian economy. And I say it's him because he is the Bank of Canada governor, and he has the ultimate responsibility for the direction of monetary policy in Canada. It's not like the Federal Reserve where you have a group of people who sit around the table and they make a decision, they all have a vote, and the majority wins. The Bank of Canada interest rate decisions are decided by the governor, and that is Stephen Poles, and so far his decisions have turned out to be a total disaster for the Canadian economy.
Now, of course, with a lower dollar, manufacturing apparently is going up a bit in Ontario and BC, and that's where people in Alberta who've lost their jobs are heading. Big sticker shock for them, though, when they take a look at the price of a home in BC or Ontario.
It's true that some manufacturing has benefited, but on a volume basis, Canadian manufacturing has lost market share not only to Mexico since the financial crisis, but also to the United States, Jim. So this dollar being pummeled down to 69 cents is not gaining market share for Canadian manufacturers. Because the problem is, if you're doing any value-added manufacturing, guess where you have to buy your machinery from? You have to buy your machinery from the United States or Japan or Germany. So as your Canadian dollar gets clobbered, as a CEO or a CFO, you're thinking, okay, this is good. This is going to improve my revenue. But boy, to expand my production line, I have to go and buy some machinery from the United States, and this is very expensive. And I don't know how long the Canadian dollar is going to be staying at 69 cents because, it's kind of overdone here. If you look at what the Economist magazine does with its Big Mac comparisons in around the world in terms of prices, the Canadian Big Mac is actually undervalued compared to the American Big Mac. So what does that mean? Well, eventually, the currency rates should align. But the problem with that is if you're a CEO, you're going to say, okay, I have to do all this investment now to expand my production line with worthless loonies, and I don't know 10 years, what the path of the Canadian dollar is going to be. So this is why we're not getting the boost in export that Stephen Poles promised that we were going to get. And, so it really comes back to poor judgment on the Bank of Canada and poor judgment on policymakers who assume that just by driving down the dollar that we're going to be able to compete with Mexico, compete with Vietnam, but we can't even compete with the United States.
Is there any area that people should be optimistic about right now?
Well, I'm optimistic that the Stephen Polo's term will be up in 2020. That's a long, wait though. And, I think that, we do have a chance with the new government's budget that they will be able to refocus policy where it should be, and that is in the hands of the elected officials. So I'm optimistic that Bill Morneau's budget is going to take a move in the right direction, where it's going to invest in, I hope, will be productivity-enhancing infrastructure projects as opposed to productivity-destroying. We'll have to see. This is will be the big question mark in the budget coming up. And we will need to ensure that the mechanisms are in place for proper governance of these projects. That being said, we have the fiscal capacity. It looks like Bill Morneau is prepared to do it. So I'm optimistic that we're going to get a decent policy response. And I know there's a lot of critics out there who don't believe that the federal government should be, quote unquote, stimulating the economy. Well, I look at it a different way. Interest rates are so low right now for governments to borrow, particularly the federal government specifically, that what we call the hurdle rate to undertake infrastructure spending has gone down quite a bit. When I mean hurdle rate, that sort of break even where the benefits are higher than the cost, because the cost will come down so much because basically real financing costs are zero for the government. Okay, so now is a great time to do productivity enhancing investments. So I'm not using the word stimulus. I'm not saying juice the economy by digging ditches and then filling them back up again. There are lots of things we can do to keep the quality of life in Vancouver competitive, because that is one of our strengths here in Canada is our cities. In Vancouver, we have a very competitive living environment. Toronto is improving quite a bit. They're starting to catch up. I think there was a bit of a deficit there, but they are making great strides in building their infrastructure in Toronto. So helping our cities become more competitive with American and European and Asian cities is very important for our country. So I'm optimistic that we're going to be making the right moves in that direction, and I think that's one of the more hopeful areas going forward.
Ted, thanks a lot for chatting with us.
My pleasure, Jim.
My guest has been Ted Dixon, CEO and co-founder of InkResearch.ca, Canada's first online financial news and research service. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Check out our popular YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.